Yeah, so today we'll do the fundamental stock analysis of Newgen Softwares. So a little bit of introduction about Newgen. So Newgen is a leading provider of a unified digital transformation platform with native process automation, content services, and communication management capabilities at the core of the products. So they have deployed their products across successful global enterprises, and it's the USP is that it's a low-code application platform, and it's used to deploy complex content-driven and customer-engaging business applications on the cloud. So the tagline for Newgen is that they unlock simple with speed and agility. So these are the products. They have three products: ECM, BPM, and CCM. The details of them are mentioned on the slide. So essentially, Newgen, through its comprehensive AI ML-led digital transformation platform, it is uniquely positioned to serve the growing intelligent automation needs of enterprises with complex content and process requirements. So they offer all the key components of intelligent automation in one comprehensive platform. So all these products are unified to make one product as well. It's around to basically to see that around 60 to 70% of the projects that the company works on are a combination of ECM and BPM, and 25% of them are ECM alone, while the remaining 10% would be CCM. But the point to note over here is that they all have the same margin, so it doesn't really make a difference from the top line, the bottom line point of view. So what are the USPs of the products? So the suite is cloud hosted single platform for process content and communication automation. So there's only single platform that the companies can use to manage across the services. It's scalable and extensible because it's based on cloud, so it's scalable as well. For secure access to processes, so they are based on AWS and Azure. So it's secure. It provides secure access across teams for all the processes. So it's highly available for data governance, capable of delivering deep insights and analytics. So conventional cloud benefits. It's used by enterprises globally to rapidly develop and deploy complex and critical business applications. They have been known to perform millions of transactions across their platforms, and it enables the remote access. So work from home is a buzz right now, and the software actually help in providing remote access to hundreds and thousands of employees, and they handle billions of documents and communication, which we'll see in the coming slides from the use cases. So these are the applications of the softwares, and we can see they pretty much offer every application across the industries. So now we'll have a look at the market opportunity. So the core three products that we have already discussed operates in content services platform, business process management systems, high productivity APAS, and process agnostic software enabling hyper automation. So all these four domains are expected to grow at least to 2.5 to 3 times of current values. The expected values are mentioned on the slides. This is something that's being taken from the company's annual report. Other critical factors are the macro factors. So the current IT service export of India is around $250 billion, and it's expected to grow at least 3 times in the coming 7 to 10 years, and that's also being in conservative estimate. So macro factors seem favorable for the industry, and there has been growth in the other buzz trends. So there has been growth in the integration of AI ML hybrid work environments, digitization transition to cloud, low code no code platform requirement, the freelancer economy again, hybrid work environments, and GSA integrations. So all these are actually in the favor of the company's growth. Now, before we deep dive into the company's numbers or the business model, we'll try to understand how exactly the journey of a general SaaS provider works. So initially, the software product is researched and developed, and once the product is ready, the product is implemented for smaller clients. The smaller clients should use the product for some time. They'll provide initial feedback to to the company, and then based on the feedback, the product would be fixed, or maybe it would be made more scalable. Then the implementation at this point in time would be done by the company itself. the support services would be rendered by the company itself, which usually increases the trade receivables, which usually is a low margin business. And then what happens is, as and when the product is improved and the product uh, keeps on making name for itself, it becomes more recognized, it keeps on winning global recognitions. What happens is that there are organizations called GSIs, global system integrators, that takes up the implementation and integration work from these companies, and at the end they'll basically do the same for their own clients. So GSIs are actually integrated, they are in contact with other bigger clients, because they actually implement all the products for these companies. So once it's being taken by GSIs, the gross margins usually increases, because the support activities and the implementation activities are taken up by GSIs, and the company as such would be charging the GSI for the license or the subscriptions. So they'll basically take the money from the GSIs. Another point to note here is the difference between the license and subscription business. So the main difference between a subscription license and a perpetual license for a SaaS business is the relationship between the fee that the customers pay to software companies and the access that they gain to the product. So for a SaaS subscription, the examples may be Spotify and YouTube Premium. Customers pay a recurring subscription fee in order to access the product based on their subscription terms. So after every, say, 3 months or 1 month, the customer would be paying the company. Customer would lose the access to product if they stop paying the subscription and are paying for the ongoing support and software updates. So as and when you are charging, you're basically charged for the subscription, you'll get the latest services, latest updates, and support as well from the product provider. And within a perpetual license, it's more like a Windows license. Customers can hold the license and access the product indefinitely. However, they will not have the access to the ongoing product updates or technical supports after a certain period of time. So that's usually beyond a year of purchasing the perpetual license. So for an year, for the validity of the perpetual license, um, they'll basically have access to the product support team. So key points to note over here is, for subscription, it basically introduces flexibility to implement various revenue strategies, because the upfront cost is lower. Increase opportunity for customer acquisition. Again, for the customer, the upfront cost is lower. There'll be stronger customer relationship, because it has to be maintained to basically control the churn rate, and lower customer acquisition cost and better streamlined profits. So you'll be able to make better estimations of when, as and when the customer would be paying for subscription. For licensed businesses, this challenge of customer churn, shorter subscription terms, can pose a risk to revenue. For licenses, there's a one-time upfront payment that's usually very high as compared to subscription model, usually for products that don't require frequent updates. So challenging for a company to sell the improved version of the software to the same clients. So what happens is that in a license business, the company usually buys the license for one time, and any improvements that are being rolled in the subsequent updates does not really go to the company as such. So for a IT product company, most of the product is being developed and the changes are ongoing, so that doesn't so it would benefit if they use a subscription model over license model. And now we'll move back to Newgen's revenue stream. So we'll see how the company is actually getting the revenue. So they have several sources of revenue. One is annuity-based revenue. So annuity-based revenue, as we just discussed, the subscription model recurring charges from the following. First is SaaS, subscription fees for licenses in relation to platform deployed in cloud. On-premise subscriptions, the ATS and AMC's annual maintenance charges. So charges for the annual technical support and maintenance of licenses and installations. Support charges for support and developmental services. Sales of software products. So one-time upfront license fees in relation to the platform developed on premises, and the sale of services, which is milestone-based charges for implementation and development, and charges for scanning services. So point to note over here is that for realization in the license business, as soon as the license is transferred, it is realized. But for services, it's more of milestone decided. which means that the company, if they are able to deliver as per the agreed milestone, the client would release the payment to the company. Or if that's not the case, the or maybe there are certain issues, the payment would not be released to the company, right? So which would cause the issue of increased trade receivables at the first place. So what is the business approach? So we have divided the business approach into two states. First is the current state, then is the desired state, and then we'll see how moving from the current state to the desired states, what would be the outcomes, right? So for the current states, they are actually upselling and cross-selling the services and products to existing customers. They're taking organic and inorganic measures, inorganic in terms of acquisitions to strengthen their products. They're spending around 10% on R&D, 10% of revenues on R&D. And so currently the product is cloud ready architecture, which is based on AWS and Azure. They're working away from license to subscription model that are more long term and sustainable. There's an increase in the marketing and sales functions, which the CEO has also mentioned, and the mention of which was also there in the company's conference calls. What they are actually desiring for? So they want to establish partnership with GSIs, global system integrators, to increase customer adoption. They want to strengthen the partner support and enablement ecosystem to provide support to partners through sales, implementation, and support cycles. They want to increase focus on annuity and subscription revenues. So they're targeting around 50% of the business should come from subscription, which at the current time is around 22 to 23%. They want to be well suited for requirements of the bigger clients. Right now, they're not working with the tier 1 clients. They're working with tier 2, tier 3 clients, which again would be contributing to increased trade receivables and bad debts. But they want to increase the quality of their clients, get 50% revenue from annuity and subscription revenue streams already discussed. They want to leverage the developed system integrator and partner network to get improved operational leverage. So what happens in IT company is that the money that the end shareholder would be making would be based on when the operational leverage will start to play out, because the cost would be fixed in an IT company and the return would keep on increasing. And they want to increase their presence in the USA region in particular. So they want to basically have more clients from the USA region or from the developed economies. Again, that will increase the quality of the clients that they have. So what are the outcomes? Right. So outcomes would be that GSI partnerships would help to get Fortune 2000 clients, hence reducing data days. They want to work for, they would have long-term associations because the quality of the clients have improved. Average deal size for the same reason. More customers from the Western world and developed economies, hence reducing the trade receivables. They want to improve the reliability of the product and enter the as and when they are actually integrated with GSIs, the reliability of the product would be improved, and the entry for the market of Fortune 2000 clients would be easier. They would have secured revenues with the accurate future projections based on subscription model, the transition to subscription and annuity revenue streams, and the ROC would increase over a period of time. We'll see if we have missed something here. Yeah, so just to sum up the entire slides, so they are working on two models as of now. One is the organic, pushing more sales and marketing, pushing the sales and marketing team to get increased top line. And second is through GSI model. And as the business transition from license to subscription, the overall employee cost should come down, margins should increase. Basically, the operating leverage should pan out, as we've already discussed. For GSIs, through the revenue stream, it is expected to go up to 50% over the next 5 years. Currently, it's around 15 to 17%. So the share that's coming from GSIs as such is around 15 to 17%, expected to go to 50%. GSI closure cycles are much longer. The ticket size for these accounts through GSI is larger than the average deal size of Newgen currently. And talking in terms of GSI again, so services software implementation is a low margin business, and GSI channel would be high gross margin. So the transition working with GSI would make sense in this case. So license to annuity shift has already started. The phase would be more aggressive now. In certain cases, the management had decided to stop the licenses, and the annuity sales would grow at a much higher rate. This is one of the checks that we should also keep in place, that the subscription business should grow greater than the growth in the entire business. Currently, the aim is to get more number of accounts from Fortune 2000 list to basically increase the quality of the clients. Now, what is the strategy? Strategy we have already discussed partially in the previous slide. So they want to focus on increasing the annuity subscription revenue streams, including moving towards increasing SaaS deployments, expansion of business and geographical footprints. Focuses on increasing business from developed economies. They are investing in direct and indirect sales channels, professional services, customer support, and channel partners. The focus is on R&D to develop product in areas of AI and ML, business intelligence and analytics, DevOps, and user experience. Cross-selling to the existing customers, and they're trying to partner with more GSIs. While the platforms are industry agnostic, investments have been made to enhance the expertise of sales and marketing for key industry verticals. So we'll see as we move forward that most of the business, around 65%, is coming from one sector as such. The platform is industry agnostic, and they would want to work with other industries as well. So they're taking expansion through inorganic routes. They acquired a company to improve their product in terms of artificial intelligence, and they are attracting, developing, and retaining high skilled employees, which is taken from the company's annual product and it's a little subjective. There's a snippet that I found, which was an interview with the CEO of Newgen Software, that they want to earn cash to take the current firm of around 100 million to 500 million in the next 5 years. We'll see. Now we'll look at certain commentaries from the conference calls. So the outlook for the next 5 years for the US markets, basically they're focusing on traditional markets that they're currently working with, which is banks. They are increasing the horizontal offering for GSIs. Currently, they are going for tier 2 accounts in USA, and they want to basically shift to tier 1 accounts through the GSI route. Europe, Middle East, and Africa, which is the EMEA business, would see growth in FY23. It is already high-based business, but the market is looking very positive for the company right now. Traditionally, it has been a strong market for Newgen, and the CEO believes that they would substantially grow that number. The concerning point here is that the current presence in the mature market is lower, and they're currently working on the sales and marketing channels for the same to increase the penetration in the mature markets. One point that probably you would be thinking at this point in time is that why would GSIs would want to partner with Newgen's product, or why would they want to partner with Newgen? So case studies have already proved, and we'll also see in the coming slides, that the product utility and the product utility is validated. They are setting separate sales channels. The Newgen is setting separate sales channels, and the investment is happening on these channels as we speak. So high degree of reliability has been established by the company, because they have been working from the last 2.5-3 decades. And the product cost advantage in terms of implementation is delivered to the GSI as such, because it's usually cutting the competitor on cost, which is not a very good thing. But initially, almost all the software companies have to do so in order to increase penetration, and then after a period of time, the operating leverage would pan out. The market share for the industries that the company is currently working would actually grow. So the size of the pie is increasing. Another point to note from the conference call is that the sales and marketing to be pushed more. R&D costs would not increase more. Gross margins is around 70%. The growth would come from the increase in the top line. Investment is in the growth, is in the S&M. Typical product companies have R&D expense around 17%, 20%, 22%. The company is already spending around 10%, and the sales S&M is 45 to 48%, which they are currently doing around 20%. So they need to enhance the spend on sales and marketing. Now we'll look at the Newgen's right to win. So they're currently focusing on professional IT developers. They have 30 years of low-code experience and domain expertise. GSI partnership for reach and scale, which they are building on. The software is natively built and skilled R&D team of 580 people. The platform is unified from the design level, which means they have actually built the platform from scratch. They have filed for 44 patents, and across 23 of them are granted. They have a cloud-ready architecture. They have got various recognitions from Gartner, Chris from Forrester, Aragon Research, etc., etc. What we have also done is we have basically benchmarked the product with the competitors as well, and Newgen actually fared out well. The company has also gotten an increase in the credit rating by CRISIL. So Forrester actually says that reference customers indicate that they use Newgen for mission critical applications, but did not indicate that they use Newgen for wide deployment across a number of smaller or more situation processes on which the company is currently working on. So we'll now, so there's another comment, and there's another claim that was made in the Gartner report that process and content centric, the product is actually one of the best in the world. If we talk about process and content centric use cases, the product is actually one of the best in the world. The principal sources of liquidity are cash and cash equivalents and the cash flow that company generates from the operations. So that is very low. Now, if we do the market analysis, so they have an established market position. The group has an established market position and presence with long-standing relationship with customers. The promoters' experience of over 4 decades in the internet software service industry and sound understanding of the market dynamics, particularly in product and enterprise services, should continue to support the business. The healthy relationship with the customers is reflected in the repeat orders from clients in the US and the European markets. They have a well-established customer base. The group has long-standing relations with more than 530 customers in over 69 countries across various sectors. Some of its customers include well-established players in various industries such as banks, insurance firms, business processes, outsourcing, and healthcare organizations. They have geographical diversified. They are geographical diversified in terms of revenue. The group has diversified geographical reach with strong presence in more than 69 countries in the fiscal year 2022. The top 10 customers generated revenue of 29%, which shows less dependence on a single client. For the fiscal year 2022, and the export accounted for 72% of the top line. Diversity in geographic reach and clientele should continue to support the business. They are improving the operating efficiencies driven by constant investment in R&D and healthy product mix. The group has a diversified product basket with multiple services and product offerings, mitigating the risk of technological obsolescence in any particular segment. The group in operations for over 3 decades is an established player in the market. The scale of operations and profitability has continued to improve with operating income of rupees 779 crores for fiscal 2022, which is a growth of around 21%. The return on capital employed levels remain healthy at 25% for the fiscal year 2022. Again, there have been enhancement in the risk profile, which is depicted by the increase in the credit rating by CRISIL. Yeah, we'll now look at the certain product negatives. So the first factor that comes out is from the Gartner report that the product is having complex deployments. So Gartner clients reported challenges with their large-scale deployments of the Newgen platform, primarily regarding complexities in deploying technical architecture. Also, additionally, the low-code capabilities that the companies usually which is the USP of the company's product, is more targeted towards the developer community rather than the empowered business users themselves, which actually increases the implementation time. So organizations looking to deploy and customize the platform should validate their implementation plan closely with their implementation partners first. Here is where GSA integration would actually help in overcoming this particular negative, because they are usually experts in terms of implementation, and they have completed multiple implementation using the same products. Second is innovation completeness. Clients Gartner has had reports from clients that some of the solutions and offerings that are new to Newgen's portfolio are not always delivered as the fully packaged products. This These offerings are usually more modern, newer AI ML services to deliver business specific solutions, and are not always available as a fully developed consumable service. So this negative can also be overcome with the fact that they are actually transitioning their license model to subscription model, and in the subscription model usually the latest update of the product is pushed to the end user. Now we'll look at certain other factors of the company's business model that will actually be a deterrent in the company's growth. So there's a high fixed cost base and susceptibility to employee attrition. So the group has had a high proportion of fixed overheads in its overall cost portfolio, making it susceptible to the quantum of work received and subsequently the level of billing. Variation in operating margin to a large extent depends on the duration, ticket size, and nature of the contracts awarded. Operations are susceptible to employee attrition, although the group has maintained a low rate over the past few years by rewarding its employees with yearly increment and the performance incentives for exceptional performance. Although the attrition rate for this particular financial year, which is FY2022, is more than 30%. Working capital intensive operations. So the gross current assets were sizable at 297 days as on March 31, 2022, driven by high receivables of 131 days, with considerable amount of debtors outstanding for more than 6 months. Large outstanding receivables are because of the long implementation phase and delayed payments from customers. However, there is a continuous improvement in the collection cycles of the company, with net debtors reducing from 149 days as on March 31, 2022 to 131 days as on March 31, 2022. So in the from to 2020, the debtors days has reduced from 149 to 2022 to 131. The collection cycle is expected to improve further as the payment in this model is received in advance in subscription, and also if the GSA implementation GSA channel builds some traction. So the collection cycle is expected to improve further as payment in this model would be received in advance. As the business is geographically diversified, so there's vulnerability to fluctuation in the forex rates. So yeah, that's all. Next part, because we have mentioned that the iteration was around 30% this year, so we'll look at the certain employee welfare policies. What are the existing measures? So existingly, they have online self-learning modules, training for new hires, etc., etc. They have ESOPs, in-house trainings, certain certifications, etc. So what new measures that they are trying to implement is they want to improve the offer to joining ratio. There's no data available in the report for the current number, but this is something that they want to keep in the pipeline as a measurement of as an improvement of employee welfare. They want to emphasis on career planning for various roles with clearly defined growth paths. Again, all subjective, data taken from the company annual report. The number of permanent employees as on 31st March 2022 was 1909, and which was last year was around 2224. The median remuneration of employees in the financial year has increased by 28%. The total number of employees has decreased due to attrition, so they have actually, I think, increased the salaries to tackle the attrition. These are the basic financials that we've taken from the company's annual reports. We'll see that the net revenue has been increasing. If we see revenue by segments, we'll see that support and ATS and AMC forms around 50%, 51% of the entire revenue. The subscription revenue has been growing. By geography, we see that EMEA, USA, and India, it's well distributed. The revenue is well distributed. PAT is also seeing an growing trend. And if we talk about the revenue by vertical, that's a little concerning because 65% is coming from banking as such. The point to note over here is that cloud and subscription revenues continue to grow at a faster rate and witness a growth of 23% during the year. For the order backlog numbers, the growth in the backlog is much higher than the revenue growth. This is something that's mentioned in the conference calls, which can be interpreted in both ways, that the company is not able to manage the orders that they're getting, or the company is getting a lot of orders which are available in the pipeline for them to work on. Okay, next we'll look at certain ratios. So debt to equity has reduced. So there's no debt. Cash flow upon debt. Yeah, so there has been a decrease in cash flow upon debt. So cash flow from operating activities have decreased from 214 crores to 137 crores, which can be attributed to increased trade receivables, which we'll see in the following slides, and also an increase in the operations cost because the offices have been opening up, and the marketing and the sales and the administrative expenses are bound to go up. The interest coverage ratio has increased because of the reduced or virtually no debt. Receivable days are getting better. We're seeing a downturn there. The ROCE is substantially higher. ROC is around 27.16%, and if we see the return of implemented capital, that is also around 20%, which is a good thing. If we do the R and D point analysis of ROE, which is the return on equity, so if we will basically understand that the assets turnover is 0.7, so it's usually coming from the profit margins. The ROE is coming from profit margins, which makes sense because it's an IT company. Certain checks that we have done is we have tried to compare the cash flow from operating activities by EBITDA. So we see that the accrual profits are converted into real profits. The median value is around 93%. So 93% of the cash of the profits that showed are being converted to cash flows. The quality of sale is not the compromise, because if we compare the increase in the sales in terms of percentage versus the increase in receivables as terms of percentage, that's also not compromised. If we compare the depreciation upon sales, that basically says that the asset lives is not changing regularly, which means that there's no accounting frauds that are centered around depreciation as such. Now we'll see the contribution of various segments to the revenue. So in the year 2022, around 34% of the revenue came from support activities, and around 30% came from ATS and AMCs, while implementation around another 25%. So the SaaS revenue is around 10%, and the software that they have sold is around 26%. So there is an increase in the SaaS revenue as such, which goes by along the management commentary, although the target that they have posed themselves to get around 50% of the revenue from subscription business is long shot, but they actually targeting within the next 5 years. So we'll see how that pans out. Although the support activities and the ATS and AMCs have been increasing in terms of contribution as such, if we compare it over the previous year. We'll see, we'll see the contribution of different geographies. So India actually contributed around 27%, EMEA around 32%, 31%, APAC 13%, USA around 27%. So the contribution of USA has decreased, but it looks like it has decreased, but there was a one-time contract that was won by the company in the year 2021, which contributed around 75% of the total top line in the USA geography, which contract was not valid this year. So they have actually grown in the USA in terms of the number of clients and the diversity of the clients. So which is a good thing, because the management is actually making sure that more business should come from the developed economies. EMEA business, the company was positive last year as well, and they're positive this year as well. They have actually registered growth in terms of revenue and in terms of the contribution as well. So the point to note over here is that management is not so bullish about the Indian business. They want to increase the quality of the clients, and thus they're looking at foreign clients. They are actually maintaining a healthy dividend rates. but which can be seen that the dividend is reducing. So they basically want to have more cash to fund the growth that we have already discussed in the previous slides. So rise in intangible assets on the balance sheet is represented by the acquisition of number theory. So the goodwill actually came up for the first time on the balance sheet, and the goodwill will be amortized over the next 5 years. The company presents a free cash flow generation of 9% on a 3-year block, which is not great, but because they're holding cash for growth, the number should not decrease, but we should actually look from a point of view of the next 5 years, the number should actually increase, because this is something that will actually end up making capital for the shareholders. So we look at the trade receivables here. So the sales quality has not deteriorated. Receivables as a percentage of sales has been reducing. So trade receivables usually come from AMCs and support activities, which are bound to decrease as per the management commentary of shifting the core of the business to subscription and increase involvement of GSIs. The drop in the receivables is not great, but from the last year, the higher value of the current but not due segment and less than 6 month segment comes from the fact that the business produces more sales in the quarter 3 and quarter 4 of the business of the year. It would be interesting to see how that fares out in Q1 and Q2, which will be verifying from the next quarterly reports. The value to be checked would be less than, for the next quarterly reports, the value to be checked would be less than 6 months, and 6 months to 1 year, the value should drop significantly there, which means they'll basically receive the amount that is due from those companies. So there are certain forensic checks that we have also done. So the miscellaneous expenses are justified. There are no contingent liabilities. There's no usual write-offs, no write-offs from equity. Changes in reserves and surplus are justified, which we have seen from the annual reports. No stock pledge from the promoters. No transfer to the general reserve during the financial year 2021 to 2022. Company has not issued any shares or convertible securities. The concerning parts are that this business is seasonal. Revenues are higher at quarter 3 to quarter 4. The subsidiaries are not audited by the principal auditors. That is the most concerning part. The trade receivables write-offs are about 15 to 17% of PBT. Collection is concerning. Ideally should be around 1 to 2% as per the industry standards. And but these are of very mature companies. EMEA of the revenue, EMEA and India has been default. The geographies EMEA and India has been default, and government contracts in other territories. Trade receivables provisionings and write-offs are at management discretion, so we are not very sure about how or what is the logic of them actually doing the trade receivables provisioning. Yeah, so couple of corporate governance checks. So only one justified related party transaction was made during the financial year. No other business interest of promoters. There were no litigations found against the promoters. Only 2 directors and KMPs are related. Rest all are unrelated. So the details are mentioned here on the slide. No promoter shareholding is pledged. The remuneration of the promoters is as per standards. There is no equity dilution. The quality of board members and CXOs is good. The board of the directors of company is fully constituted with proper balance of executive directors and non-executive directors and independent directors. We've actually compared the company with the competitors as well. So we'll see the employee cost is actually lower if we compare it to other competitors, Tanla and Coforge. The operating margins is a little higher. They have higher reserves. They have decent amount of cash in cash and cash equivalents. The receivables is also lower if we compare it to the competitors. So which means that the company is in a better place if we compare it to Tanla and Coforge. So we'll see what is the thesis of us investing or not investing. So for the company to be successful, US has to be the primary market, and the growth driver in the short term. Growth is achieved from EMEA or India market, but US has to grow for the company to be successful. we'll keep a close eye on how the US market performs. In the BFSI segment, it works on network effects. The more referenceability and recognition the product has, the more it would sell. The contracts through GSI should increase in the next year's annual reports. This is something that again we'll have to check. The IT exports from India is expected to increase because of the current macroeconomic environment, and hence the company can be the beneficiary of the same. The freelancing and outsourcing economy is bound to increase in the Western world, hence the digitization as a theme is expected to grow. The GSI story would help them open to the tier 1 accounts or the tier 1 clients, which would help them improve the financial ratios and operational efficiency. The marketing efforts that the company is increasing the spending on would help them get increased revenues. There's a rise in the contribution of the subscription services to the entire revenue. So currently the rise has been there, although it's slow, but we'll see if the contribution of the subscription business actually increases in terms of the entire revenue. Now coming to the NTCC pointers. Geographical presence, Newgen's global presence is primarily based in APAC, the Middle East and Africa. Newgen saw revenue growth in North America, but still rarely appears on the shortlist there. Prospective clients in North America and Europe needs to evaluate Newgen and its partner local delivery and support capabilities. Currently, Newgen wins on undercutting competition, which is not a very healthy way of growing. Working culture and employees are not rated well. Across social media and sites like Glassdoor, there are several comments concerning the work culture, hierarchy, project quality, and work-life balance. With the attrition this year, more than 30% retention of employees is of utmost importance. If the number keeps on growing, that would be very deterrent to the company's performance. Banking and financial service vertical continue to be the largest vertical, comprising 65% of the revenues during the year, followed by government, insurance, healthcare. There's too much reliance on one sector. That is something that the company needs to tackle. The various threats that the company addresses include uncertain global economic conditions, changes in fiscal, economic, and political conditions in India, and the currency risk, increasing competition, changing technologies, and regulatory changes in the industry the company operates in, which is, I think, a risk for almost all the companies that are operating in this particular industry. The subscription model would result in greater churn among the existing clients. So currently, they are working on a thesis that subscription model will help them increase the customer base, but there might be increased churn. So we'll have to figure out how this pans out in the next report. If we talk about how do we plan the execution stop loss, so margin pressures would be there because of salaries, travel resuming, marketing. Near-term net margin is expected as per the management to be around 18 to 19%. EBITDA should be around 23 to 24%. There should not be great divergence from these targets. Otherwise, we'll have some doubts on how the company is executing. For GSI, through the revenue segment is expected to go 50% over the next 5 years. Currently, it's around 15 to 17%. The value should not reduce in absolute or percentage terms. So in case it is reducing, the management is not going by the plans that they're speaking in the conference calls and the annual reports. Revenue through subscription should increase, expected to be over 50% in the next 5 years. Growth in the US market is not picking up. In case it continues to not pick up the cash flows from operation, so that's also a concerning factor. The cash flow from operation should increase, coupled with a decrease in trade receivables. Dependence on one use case for business, and we have discussed in the previous slide as well. The other business use cases should also increase. The higher value in the current, but not due and less than 6 months comes from the fact that the business produces more sales in Q3 and Q4. It would be interesting to see how that fares in the next year's Q1 and Q2. The value to be checked would be less than 6 months and 6 months to 1 year from the trade receivables, and they should actually decrease for them to actually make sense of the net number that they have recorded now. The employee attrition should reduce from the current levels, and if that's not reducing, again a contribution to the execution stop loss. The free cash flow should remain positive, ideally should remain constant or increase. Free cash flows over the block of over a block of 3 years that we saw was 9%. That should ideally increase or should remain constant. So that's all. Thank you.